Hello, everyone. I'm Matt Clark. I'm research analyst for Money Markets. Joining me as he does each and every week, whether he wants to or not, because we actually make him do it, is Greens and Fortunes co-editor Charles Sizemore. We are back with another episode of Investing with Charles. Charles, going to go right into your wheelhouse today. It's not a specific question, but it's a topic that we've talked about a lot. Whether I've talked about it in other videos on YouTube or we've written about it or things like that, and that is REITs. Now, REITs I'm just going to jump right into it. There's no point in building it up. But REITs, first off, I want to talk about what REITs are, because they are a potentially effective investment tool for someone's portfolio. So briefly, let's start with, what is a REIT?
Sure. REIT is an acronym for Real Estate Investment Trust. It's publicly traded real estate. It's not real affordable for you and I can go buy a house. We can't go buy a multi-million dollar 50-story skyscraper. That's not realistic for an ordinary investor to buy. Something like a real estate investment trust allows you to get access to an institutional portfolio of real estate assets, but you get it in the convenience of a stock that you can buy and sell just like any other stock. You can put it in your brokerage account, your IRA, whatever. So it's publicly traded real estate, and particularly if you're an income investor, it's almost hard to avoid not owning them, at least as part of your portfolio. They tend to be one of the highest yielding sectors of the market. Part of that's just because real estate in general is income focused. But then secondly, REITs also have some special tax provisions. Congress, in its infinite wisdom, decided they wanted to facilitate growth in real estate and make it more investable. So one of the incentives they gave was a rather large tax break. So long as REITs distribute 90% of their net income, they pay no federal income tax. So that when you're not paying taxes, it's kind of a virtuous cycle. When you're not paying taxes, you have more cash available to make as dividends, and there you go. So that's REITs 101.
But now there is a bit of an issue here. Now, while it sounds very attractive, if you are maybe someone who wants to dabble in real estate, but not actually buy property, or as you said, don't have the money to buy massive square footage of malls or office buildings or things like that. A REIT is a definite place to turn. However, there is a problem with REITs. What is it?
The problem. It's not so much a problem as, I guess we'll call it a problem for lack of a better word. Real estate may be a nice asset class, but not all real estate is equal. And post-COVID, do you really want to own an office tower? Is that really the asset class you want? Now, obviously, some office towers will be fine, but as a growth asset class, you're looking at something where you're going to have high vacancies for years. So that may not be where you really want to put your capital. Shopping malls, another large REIT sector. Do you ever want to buy a shopping mall again, considering that Amazon.com exists? So, clearly not all real estate is equal, but that's where REITs get fun, because just like mutual funds, just like ETFs, just like stocks, just like every other way you can slice and dice the market here, there's sectors and subsectors and subsectors. You can get really, really specialized. And so when you look at REITs, what I really like I like growth-oriented REITs. They may not be the highest yielding, but they're in segments of the market that are growing. And we picked out a few of those to talk about today. One I particularly like, I mentioned Amazon before. So Amazon is, of course, destroying retail. They have been destroying retail for 20 years. They will continue to destroy retail 20 years from now. There's a lot of retail that is able to be, there's a lot of retail available to be destroyed. So Amazon will be destroying retail for the foreseeable future. But rather than cry about that, rather than identify that as a problem, you identify it as an opportunity by buying one of Amazon's landlords, Prologis. Prologis is a leading REIT in industrial real estate, distribution centers, things like that. That gritty, boring real estate you don't really want in your backyard because you don't really like trucks coming and going in the middle of the night. It's not really the most attractive thing to have in your neighborhood. It's a very attractive thing to have in your portfolio.
And Prologis trades under the ticker symbol PLD. Right now, just looking at a 12-month chart, it's up about 109% over the last 12 months. Still slightly below its 50-day moving average because it had a nice spike up at the beginning of the year. But yeah, this is a what you might call a last mile REIT. This is where warehouses are really companies, retailers, e-commerce retailers are really struggling and wanting to get more impact into that last mile, which is that last mile from the warehouse to delivery. They want to make that
and even more fundamental. Yeah, people just marvel at Amazon, and I marvel at Amazon. It's amazing. You just pick up your phone in 30 seconds, you've ordered something, and it's arriving at your house before the end of the day. It's an amazing, elegant system. However, what you see as a user is just the attractive software. There's all this world that you never see, all of the logistics involved with getting the whatever $5 electric toothbrush you ordered, getting that to your doorstep. There is this entire ecosystem that makes it happen. And Prologis is one of the stocks that they're part of that chain. They're part of that ecosystem. So I think if you're wanting access to what is one of the most obvious and durable trends of the next 20 years, just the continued rollout of e-commerce, the continued dominance of e-commerce, this is one really nice way to play that and get paid dividends along the way.
Other avenues out there in terms of REITs. So you talk about the speciality of it and how you can really be specified in terms of what you're looking at. You don't have to be all encompassing or anything like that. If you are looking at a particular growth market in terms of space, let's just call it that. Another one would be basic necessities. Talk about that a little bit.
Yeah, sure. So I don't really go to the mall anymore. I haven't in years, but if I need whatever, I mentioned the electric toothbrush, I'd actually be a lot more likely to go to the local pharmacy to get that than I would order on Amazon. There's a lot of just basic things that it's not worth your time. It's actually more convenient to just go do it in person because it's a convenience store. It's a pharmacy. You need a prescription drug refill, whatever. So REITs that specialize in those high traffic kind of convenience stores and kind of what would call kind of high traffic retail, if you will. Those are also very attractive. One of my very favorites is Realty Income. That's a stock that you can just kind of buy, put in that proverbial drawer, not look at for 20 years and just let the dividends accumulate. The thing pays monthly dividends, which is fantastic because they compound faster. The REIT raises its dividend nearly every quarter and has for as many years as I can count. It's just this rock solid performer there. It just you never have drama with it. It's not even a low drama. It is a no drama stock. Along the same lines, Store Capital is interesting. Store Capital is a similar concept. Triple net retail REIT. They focus on kind of smaller, kind of high traffic tenants. They have more of a services focus though. So while goods are at risk of just continued, attack from Amazon, you can't order a dentist on Amazon. You can't order a veterinarian for your dog on Amazon. You can't order a haircut on Amazon. I suppose you could, but that would really be weird. So, for these services where you have to go somewhere, you have to go to that dentist's office, you take your dog to the vet, you got to get a haircut. That's where that REIT really excels. They own that high traffic, service oriented real estate, the stuff that is as close to Amazon proof as you can possibly get.
Realty, which is trades on the ticker O, I believe. Right now, it had a bit of a down over the last 12 months, but it has really fought its way back and is starting to see some new life. STOR was the other there, and it also had a bit of a struggle, but is starting to mount itself back in terms of its stock price. Now, I want to switch gears over to what is probably one of my favorite avenues, and that is data centers.
Yeah. Yeah. So that's another, 5 years from now, are you going to be using more data on your phone or less? The obvious answer is more. I don't know of any human being that uses less data today than they did 5 years ago, or that doesn't expect to be using more data in 5 years than they are now. Netflix, Amazon Prime, Disney Plus, whatever, everything you could Paramount. You're actually the one dude that has Paramount and not Netflix, by the way. I just want to point that out.
And I'm fine with that. I'll live with my shame.
So about that, all of these, they require data centers. Amazon.com requires data centers. Your bank requires data centers. The U.S. government requires data centers. Everything that you can imagine requires a data center now. And for redundancy, for security, companies like to spread them around. They like to use different providers. Some they build themselves. They own their own data center. In some cases, they'll use a third party like digital realty. So that is a really, if you want to talk about a trend that a safe trend, one that you don't really have to worry about reversing anytime soon, the rise of data centers. I think this is an excellent REIT to play that trend.
And I remember, just a brief aside here, when I was in newspaper, one of my last newspaper jobs was the editor of a newspaper that actually had a Facebook data center in its backyard. There are 2 Facebook data centers in the United States. There's one in Sweden and there's one in China. And I will tell you that this data center that Facebook has was impressive, to say the least. 0 carbon footprint for a data center that is acres. It looks
like something from science fiction on the inside. You go inside and it's just wall-to-wall computers, and they have to keep the temperature low so that the computers don't overheat. It really does look like something from a movie.
And it is just wall-to-wall servers, because we are talking about massive amounts of data. And you're absolutely right. Everyone has to store data somewhere. Anyone that is in the space.
Every picture you take on your iPhone, that photo goes somewhere. It goes to iCloud, and where is that's in a data center somewhere. It's
Apple, AT&T, Verizon, all the cell phone companies all have data centers, and they're spread out. And what DLR does is they find that property that has the essentials that data centers need, and we're talking about solid electricity and very close access to water, because that is what data centers need in order to operate. And that is what DLR specializes in. Right now, DLR, if you look at REITs over the course of time, at least over the last 12 months, you'll see kind of a common pattern where we had a run up, a drop, and now we're seeing the REITs starting to make a comeback now. DLR up 5% over the last 12 months. Then finally, the last one I want to get into here is something that's probably near and dear to millions of Americans who just either don't want to or can't or just refuse to buy a home. And that is, when we think of real estate, obviously you think of buying a home. That's one of the first things that comes to mind. But real estate also has a place in the rental market as well. So let's talk about rental homes and rental property.
Yeah, so American Homes for Rent was really a pioneer in this space. It was always assumed before that single family homes were just too small to get the attention of a REIT. And really what it boiled down to was no one had really invested in the infrastructure to do it. And so I own one rental house, and I pay, I don't even remember, $120, $130 a month to the manager, and they take care of everything. And they do this for about 1,000 other homes. And there's no reason why that couldn't have been translated into a REIT sooner, but it just never was. American Homes for Rent took care of that. They became the first major player in that space. And this is, this is really the simplest area of real estate for most people to understand. Homes they have some cyclicality in the sense that, when times get tough, perhaps you move back in with your parents, perhaps you downsize. There is some sensitivity to the economic cycle, but not that much. At the end of the day, you have to have a roof over your head. You have to have a place to live. You may, cut back your expenses here and there. You may go a few extra years before you buy a new car. There's any number of things you may do to cut back, but you still got to have that roof over your head. And that's why something like American Homes for Rent is a very nice counter-cyclical stock. Where it also gets interesting is they have been raising their dividend like gangbusters. They just this past quarter, they raised the dividend by about 80%. And that comes about a year after they raised the dividend by 100%. So these guys are it's not the highest yielding REIT you're going to find. It yields less than 2%, I believe, but it does. They do raise that dividend like no one's business.
And AMH is a ticker there, reached a 52-week high back on the 1st of January, paired off a little bit, but still up 44% over the last 12 months. And just to kind of put everything into context, the real estate investment trusts area, the sector, up 35% over the last 12 months. So you've got AMH, which is up 44, doing much better than the average gains for the average total returns for real estate investment trusts as a whole. So we've talked about Prologis, which is basically Amazon's landlord. We've talked about basic necessities, which we're talking about REITs that invest in property that are used by convenience stores, drug stores, big chains like that you're probably familiar with. We have O, which is realty income, and then we have STOR. When we talk about data centers, you have DLR, and then with rental homes, you have American Homes for Rent, or AMH. So last word on REITs, Charles. What would you tell someone who wants to break into this but isn't really sure how?
Yeah, it's easy. It's as easy as buying a stock. If you can buy a stock in your brokerage account, you can buy REITs as well. They are an excellent inflation hedge. If you are worried about inflation, which who isn't these days, tossing some of these in your portfolio can be that nice additional inflation hedge that also pays a very nice and generally growing stream of income. So
REITs, solid income plays. These are most REITs. If they are to in order to meet tax exempt status, they have to pay back 90% of their net earnings to shareholders in the form of dividends. I believe all these that we've talked about today all pay dividends in some form or percentage.
Yes, they do.
So, there's a lot of options out there, especially REITs the way to go. Instead of trying to be all encompassing, drill down, find out what sectors have the most to gain from the current economic conditions we're in. And we've kind of touched on that. We've got warehouses, we've got basic necessities, data centers, rental homes, and there's a lot of avenues to play out there. Charles, certainly appreciate the time. Look forward to doing it again. If you do have a question for myself, for Charles, or for Adam O'Dell, we would love to take it. You can email us. Our email address is feedback@moneyandmarkets.com. We'll drop that down below, or you can actually comment down below on our YouTube page, on our YouTube channel as well. Love to see what you have to say. Check out moneyandmarkets.com. It is your home for safe, sound, smart, simple, profitable investment information. You can check out our stock power rating system, where you can put in the ticker of any number of stocks, and you get it broken down by 6 different metrics, how we rate it. You get technical information, you get also fundamental data and any research that we have on it. And then to take a step further, if you're looking for even more in-depth research and those stock recommendations that we know are going to give you at least 3 to 4 times beating the market over a time period, then you want to check out Green Zone Fortunes. This is where Adam, Charles, myself, our entire team work very hard to give you all that research, and it's all right there, and it's all for you. I believe less than the price of a cup of coffee a month. You can get all access to all that. We'll float a link up there as well for Green Zone Fortunes. He is the man, the myth, the legend, Charles Sizemore, co-editor of Green Zone Fortunes. I'm Matt Clark, research analyst for Money Markets. Until next time, everyone, safe trading.